what a wild couple of weeks we've had. And I look up at the board and interest rates are still extremely firm. We have $83 billion in 3s, 10s, and 30s, starting with 3s today, a supersized package. What can you tell me that investors should pay most attention to when it comes to the fixed income and interest rates?
Two things. First of all, that fixed income markets have been poised for increased growth, and we've seen that growth really triangulate to higher rates over the past 1 to 2 years. And investors should be prepared for those high rates to come forward in the next year or so as growth continues. We've had fantastic economic numbers the past few days, and investors really need to be poised to embrace those economic numbers. Understand that while financial conditions are tighter, meaning stock markets have become a little bit more wavy over the past few weeks, ultimately that leads to confirmation that the Fed is going to increase rates at least in December and probably 2 more times next year. And as such, investors really need to be prepared for higher rates to come over the next year by favoring front-end allocations. And number 2, slightly higher inflationary pressures, whether it's due to wage pressure or not. But that's not necessarily going to derail the Fed's focus for the near-term pressure. And the second element, quite honestly, is supply, as you mentioned, and that has implications for the term premiums. In other words, the differential in the shape of the yield curve and ultimately what investors want to pay for owning treasuries versus other securities in the world. And right now we favor steepening bias as further out the yield curve due to increased supply.
The 30-year's been acting, that's impossible not to think that strategy is the correct one. Here's my problem, is that investors do tend to be lazy, and like tomorrow's midterms, when you look at polls, they tend to look at static information. And the static information in this case is the metrics for future discounting of earnings is going to change with higher rates. We all know that, but that's nothing to be nervous about because the economy could make that up in growth ways we just don't know yet.
Right, and that's what the Fed's ultimately thinking about is if you have growth continuing along that way, then they ultimately meet their growth objectives of job creation and inflationary protection as well. And as long as that remains consistent, expect this normalization process to continue over time. Investors should be comfortable with that. But the key factor which investors continually overlook here is that with increased normalization, meaning approaching that 3% rate and maybe even potentially beyond, which the market isn't prepared for, as we approach that 3% rate, expect volatility to emulate and permeate the markets, and conditions that we've seen over the past few weeks are frankly going to persist. It's part of the normalization
and I'll
condition.
tell you what, if you look at all the risk parity trades out there, if volatility persists, and we have no reason to think it's not going to, it is going to have an ongoing effect on equities.
Without a doubt. Investors need to change their psychology a bit. They need, instead of buying the dip, they need to mind the dip. And minding the dip is meaning prepare portfolios for increased volatility, changing liquidity costs, meaning they're going higher, and ultimately changing cost of capital.
We're almost out of time. You see any surprises for this week's November Fed meeting?
No. If I look at the communication simply for continuing increased normalization and focusing on the front end as the source of value right now.